In the video, we have covered the following topics. Hurst Exponent is a measure of market memory, analysis and methodology, dynamic market regime detection, application of Hurst Exponent, and a multi-asset model beating S&P 500 buy and hold without any parameter optimization.
Hello, my fellow Quant enthusiasts and some degenerates that we might have. So, the topic for today's video in the cohort is the Hurst Exponent. The Hurst Exponent is a really powerful tool that I've personally used in a few of my models, and it's a highly rated tool. So, it works just like an oscillator. RSI, it has 0 to 100 values, but here we have 0 to 1. So this is 0, this is 1. Yeah. So the Hurst exponent oscillates in this area, and it captures the long range memory of time series. It can tell whether a series is trending, mean reverting, or acting like pure noise. As you can see on the screen, let's start with the historical background. The story starts with Edwin Hurst, British hydrologist who was working on how large should a reservoir be to handle the Nile's unpredictable flooding. It was very common in the early ages that Nile used to get flooded a lot. So the Nile River exhibited long range dependence. That's the discovery that was made by Mr. Hurst. High water tend to be clustered together as did low water years, which is far more than pure randomness would predict. So he quantified this, he called this a rescaled range, and the scaling exponent he derived became the Hurst exponent. So there was this Mandelbrot extension in 1960s and 70s. Benoit Mandelbrot, the father of fractal geometry, connected Hurst to fractional Brownian motion. So standard Brownian motion is independent, whereas fractional Brownian motion works on correlation. So it was a generalization of standard Brownian motion where increments can be correlated. Yeah, exactly. So in financial markets, he argued that assets return even larger long memory and bigger fat tails that entirely violated the efficient market hypothesis. The modern usage, we will be focusing on quantitative finance. Let's interpret the basics of Hurst. So if the Hurst value, the formula is on the screen. So if the Hurst value is 0.5, it has no memory, it's a random walk, it's completely randomly distributed, zero predictive power. If the Hurst is above 0.5, it's a persistent trend following system, and then if it's less than 0.5, it's anti-persistent, means mean reverting. It means that the series exhibit long range negative autocorrelation. So basically negative beta if one stock is going up. If let's say index is going up, the stock doesn't tend to go up, it tends to go down. And let's talk about the summary table. As I said, in 0 to 0.4, it's strongly anti-persistent like bid-ask spread, and then 0.4 to 0.5, it's interest rate differential, which is weakly anti-persistent. Random walk at 0.5, which validates the efficient market hypothesis, but we don't believe in that. Yeah. And then 0.5 to 0.7, mild momentum, equity indices 0.7 to 1, strongly persistent, strong trend following assets like volatility, commodities, and cryptocurrencies. So the classical method of phase scale range analysis, there is step 1 mean, the formula is there, cumulative deviation range, standard deviation, rescale range, scaling law. If you people want me to deep dive into maths as well, we can do that, just let me know. But right now I'm focusing on a larger spectrum of audience. So as I said in the introduction video, if you are already in the cohort, you must have seen the introduction video. Our main job as a quant is to get positive expected value over thousands of tests. So this is the formula for expected value for a random walk by Ennis Lloyd in 1976. Now connecting it to fractals and self-similarity. Talking about fractional Brownian motion, so with the fractal Brownian motion, it includes the correlation part as well. So if Hurst is 0.1 and instead the fractal dimension will be 1.9, considering a extremely jagged space filling character, 0.5 which is again standard Brownian roughness, 0.9 or 1.1 for fractal dimension is a very smooth, nearly a line. So then we come with variance scaling and the spectral interpretation. These are the advancements that you can use in Hurst Exponent. Then we come to the Joseph and the Noah effect. So Mendel brought named two key phenomena after biblical figures. The Joseph effect is a long memory effect, refers to long range dependence. So it needs to be let's say 500 for a long range dependence, and the Noah effect is a fat tail effect, refers to higher V tail distributions. Rare but extreme jumps are far more likely than Gaussian models predict. That's why we do Monte Carlo as well. Talking about, let's continue with the code part. So if you're already in the cohort, you will be getting the Hurst Exponent Jupyter Notebook and the Basket Hurst Model Jupyter Notebook as well. And this video is also setting up as a demo on YouTube. So if you are in YouTube, you want to access the code notebooks, you are more than welcome in the cohort. Starting with the code, so we generate synthetic time series with known Hurst exponents, implement from scratch, verify our implementation against value, visualize results. So this is the generating synthetic fractional Brownian motion. We calculate the fractional Gaussian noise using the Cholesky decomposition of the autovariance matrix, then cumulate to get the fractional Brownian motion. This is the formula coming down to this is the result output. Now visualization is a core part of, at least for me, on how to build the intuition and how to build up from the foundation. So how Hurst affects the visual character. Low Hurst is jagged, choppy. High Hurst is smooth and trending, as we have discovered. So this is the visual for that. As you can see, an anti-persistent mean reverting, it goes up, then it chops back down to its fair value, and then random walk is the persistent trend. As you can see, it is almost a straight equity curve line. Then implementation from scratch, verification on synthetic data. As you can see, this is the log plots for synthetic fractional Brownian motion. The error is calculated. Now talking about Hurst, rolling Hurst. So in practice, Hurst is not constant over time. Market shifts between trending, mean reverting. So we use a rolling window to reveal these transitions, as well as to avoid look ahead bias. We will be talking a lot more about look ahead bias, survivorship bias in the beginner pillar. We will be discovering all sorts of quant mistakes that you can make, that can make or break your model. So in this, you can always optimize your rolling Hurst exponent on the data set, but avoid overfitting. So in this case, we used, in the model I used 63 as a rolling Hurst. That was 3 months, 21 days are the working days, and into 363. So right now, coming back to this rolling Hurst, 0 above 0.6 song persistent, trail trend following trail stops. Then 0.5 to 0.6 mild persistent, cautious momentum. You should not heavily scale into your position. 0.5 reduce position sizing immediately. Less than 0.4 song and mean reversion. Now this is the graphs for this composite, trending, random, and mean reverting. So as you can see, this area is the trending part, this area is completely random, and this is the mean reverting. So, and this is the, in this default I have taken 300 as a window. We will shift to basket, it has 63. Now it shows persistent and anti-persistent plot. Now talking about detrended fluctuation analysis. Let me show you why we use detrended fluctuation analysis. It's at the bottom in the limitations part. Yes. Yeah, limitations and pitfalls. So we use DFA, test for breaks, for non-stationarity. Alright, so coming back to, just a second. Yeah, detrended fluctuation analysis. It's more robust than RS for non-stationary series. As you might know, financial markets are very non-stationary. A $10 move in 2015 means entirely different story, whereas a $10 move in 2025 is an entirely different story because of a lot of factors that have to be factored in, like macroeconomics like inflation, purchasing power parity, GDP growth, etc. etc. Now, coming back to trend sensitivity, RSS high, and whereas DFA detrends each segment, taking each window and each segment and it detrends it. Short range correlation can bias the Hurst towards the upper side to give false positive signals, whereas DF is more robust. Non-stationarity, it RS assumes stationarity, whereas DFA handles it. Now the algorithm on how we can integrate it and segment it into blocks of n. Now let's come to real world financial application. This is we will apply our estimator to real assets and answer the following. So we will compare it against S&P 500 to know if it's trending, random or mean reverting. How does the regime evolve over time? Does different assets exhibit different memory structures? So for this, as you can see the output, we have downloaded S&P 500 ETF, that is SPY, GLD for gold ETF, and 28 Treasury ETF plus Bitcoin. So the global estimates are done, regime is detected, and then comes the brilliant plotting part. I just love visualizations and plots. So the multi-asset rolling Hurst, as you can see here, right here, it's a 252 rolling Hurst, and it was mainly in a trend following. And as you can see in gold as well, it was trend following, and 20-year Treasury bond, it was also trend following. Bitcoin as well, trend following. Now log diagnostic plots. The quality of linear fit in the log plot tells us how well the power law assumption holds. A poor fit suggests the series may not follow simple scaling. Alright, so these are the visual graphs for that. You can go through these, and let's continue on to his advanced topics. Generalize Hurst exponent, and like the if h of q is constant for all q, it's monofractal. It assumes that there is a uniformity in the output in the series, whereas if it's multifractal, it does not. It assumes that small and large price movements scale differently. The main part is the scaling part. Talking about the limitations and pitfalls of Hurst exponent, if the series is short, unreliable for short memories that are less than 500, use longer series, report CIs. And talking about non-stationarity, breaks bias. H towards 1 means that it creates a bias that pushes false positive towards 1, giving more signals towards trend following. As we talked about it, we can use DFA and test for breakouts. Now price versus returns. Price are always non-stationary. We can always mitigate that using logarithm returns or increments. Small sample bias, RS overestimates. Hurst use any slow correction, single estimate, hide regime changes. We avoid that using rolling windows. So the trading applications, it's some regime filter, pairing trades, volatility forecasting, dynamic position sizing. You can combine it with ADX, Bollinger Bands, and a lot of other things that we will be covering. The model making part will be entirely different, where we will be taking XYZ parameters that we learned about, and we will try to find a combination that will work on a multi-asset basket or a single asset. So summary, what measure of long memory, who, classical method, everything we have covered. These are the references. Now the main part, let's talk about the so I don't want to just yap about Hurst exponent and not show you the statistical advantage of using it. I want to prove it to you that each of the parameter that we learn here has a real time application. So I have created a random basket of trading model. So the universe is 9 risk on tickers and 1 risk off tickers. The risk of tickers I have taken bonds, 20-year yield bonds, as you can see here. It's the only risk of ticker, because when the market regime is off from risk, we have to hedge our positions using treasury ETFs. So this is the current asset universe. As you can see, it's highly diversified: commodities, stocks, ETFs, and Bitcoin. So let's give the strategy overview. One thing, this model is not optimized at all. I have taken random values, like the 63-day window is completely random. The selection of top 3 assets is completely random and a choice that I made, and even rebalancing bi-weekly every 10 trading days is completely random. These parameters are not at all optimized. We will go through how to optimize them and avoid overfitting for a good model. So let's continue with this. So the universe is 10 assets, daily time frame, ranking is using 63-day window, top 3 assets, risk of rebalancing bi-weekly allocation, equal weight among selected. I haven't used Black Letterman model or any advanced models, and the look ahead bias has been avoided by using T+1 shift. What is T+1 shift? So we will be covering it in the beginners part, but just to give you a reference, T+1, let's say the signal was generated on candle T. If you don't specify in your model that the entry has to be done on T+1 opening, it accidentally enters on the opening of T candle, or in at the high of T candle, or low of T candle. We have to avoid that. We have to avoid look ahead bias that can lead to artificial results. So strategy logic, it's a very basic logic. We compute Hurst Exponent, shift signals by day 1 every 10 days, rank all assets using their lagged Hurst, select top 3, equal weight. If fewer than 3 qualify, allocate the remaining weight to TLT. If none qualify, go 100% risk off, that is 100% TLT. Now this is the code, this is the data download, this is the normalized price chart, and then we compute the rolling Hurst. Again, if you are already in the cohort, you will already have access to this code notebook, Jupyter notebook, and you can along the video. When I'm personally learning, I love to have a window of the video that I'm watching, and as well as some reference material that I can go through. So continuing, this is the rolling Hurst line chart, backtest engine, as we talked about. And now the best part is the performance. This is a completely unoptimized Hurst strategy versus S&P 500 buy and hold. And all of you believers who believe in the efficient market hypothesis, I'm going to prove you wrong, as well as those fake ass gurus, trading gurus that you follow that claim extraordinary returns. They can't even beat buy and hold, I can bet you that. So the performance is the following. It is a backtest from 2018 to 2025. As you can see, the maximum drawdown is similar to S&P 500, which is about 32%. But the best part is you can see how it majorly beats S&P 500 buy and hold. Now, how? Let's see. The CAGR is 3 times more, almost 3 times more than S&P 500. This is a very basic model. Trust me, we haven't gotten to the advanced part yet. The Sharpe is double of S&P buy and hold. The maximum drawdown is similar though. The win rate is increased, the profit factor is increased, the total return is approximately 7 times more than S&P 500. This is the holdings and the allocation. This is 250 rebalances chart and TLT held in any weight, the heat map for monthly returns, the annual return comparison, the rolling Sharpe. Rolling Sharpe is very important, so you know at given periods of time what was the Sharpe ratio of your portfolio and your model. Rebalance log. Key takeaways: the backtest is look ahead bias free. The risk of mechanism is quality because we are going to a low risk asset. Potential improvements which you can do, again, optimizations like momentum overlay, combine Hurst with trailing returns, inverse volatility weighting, walk forward, optimizing minimum Hurst dynamically. Again, this I didn't add transaction cost slippage. It won't make a lot of difference because it's a macro model, but still something to consider. We can always consider multi-window Hurst and long and short variant. So Guys, this is everything that I had to talk about Hurst Exponent. I hope it was a value addition to you, and if you like the work, you can subscribe, give a follow on Instagram. It's quant.trader with double R's. And if you really want to deep dive more into quantitative finance, I suggest you join the cohort. Guys, hope to see you there. Signing out, Quant Trader.